Thank you again for taking the time to meet with me. Last time, we covered the basics of reinsurance, and it really helped me understand why insurers rely on it. But I've come across two terms, treaty reinsurance and facultative reinsurance, and I'm not entirely sure what they mean. Could you explain the difference?
Of course. Treaty and facultative reinsurance are the two main types of reinsurance, and understanding them is essential for any underwriter. Let's start with treaty reinsurance. Treaty reinsurance is essentially a blanket agreement between the primary insurer and the reinsurer. In this agreement, the reinsurer automatically covers a specific portfolio of risks without reviewing each individual policy. It's typically used for a certain line of business, like motor or property insurance.
So, with treaty reinsurance, the reinsurer agrees to take on a whole group of policies, rather than looking at each one individually?
Exactly. The key here is that the reinsurer doesn't assess each policy before accepting the risk. Instead, they agree to cover all policies that fall within the scope of the treaty. This makes treaty reinsurance highly efficient, especially for insurers with large portfolios. It provides automatic coverage and helps streamline the process for both the insurer and the reinsurer.
That sounds very convenient. But are there any downsides to this approach?
Good question. While treaty reinsurance offers efficiency and consistency, the reinsurer takes on more uncertainty because they don't get to choose which individual risks they accept. For the primary insurer, however, it provides certainty that they'll have reinsurance support for all qualifying policies within that portfolio. It's often used when there's a high volume of relatively similar risks.
That makes sense. So, treaty reinsurance is great for high volume, predictable risks. How is facultative reinsurance different?
Facultative reinsurance is much more tailored. Instead of covering a portfolio, the reinsurer evaluates and decides whether or not to cover each individual risk. Essentially, it's on a case-by-case basis. This type of reinsurance is often used for large or unusual risks. Think of something like an industrial facility or a skyscraper.
So, with facultative reinsurance, the reinsurer gets to assess each risk before deciding whether to take it on?
Exactly. Facultative reinsurance gives the reinsurer more control over the risks they accept. They can choose to reinsure a specific policy if they believe it fits within their risk appetite. For the primary insurer, this type of reinsurance is often used when they need coverage for risks that are too large or unique to fit into a standard treaty reinsurance agreement.
It sounds like facultative reinsurance provides more flexibility for both sides, but it also seems like it might take more time to arrange.
Facultative reinsurance does tend to be more time-consuming because each individual policy has to be reviewed and negotiated. However, the trade-off is that it allows both the insurer and the reinsurer to handle exceptional risks in a way that's tailored to the specifics of each case.
So, treaty reinsurance is more about efficiency and broad coverage, while facultative reinsurance is more selective and tailored. Does that mean insurers typically use one or the other?
Actually, many insurers use a combination of both, depending on their needs. Treaty reinsurance is often used for standard, high-volume business lines, providing automatic coverage for all qualifying risks. Facultative reinsurance, on the other hand, is reserved for exceptional or complex risks that fall out of the treaty agreement.